But welcome, Mr. Mrio Singh. Please come up to the stage for your presentation, please.
Hello. Okay, did you have a good lunch? Are you awake? Yeah? Okay. Now let's go for part 2, all right? Before I talk about money management, I need you to understand the 3 laws. Okay, I'm going to draw something for you. In trading, you need to have 3 circles. Okay, the first circle is money management. Okay, this circle is strategies. And this circle is state of mind. Let me explain. Strategies means how do you enter the market? Do you buy here? Do you sell here? Do you stay out? Okay? All that is strategies. Tomorrow we will talk about strategy. Okay? I'm going to show you some strategies for you to immediately start trading the Forex market. Today, now, I'm going to talk about money management. Money management means how many lots do you play? Should you trade 1 lot, 5 lots, 10 lots? You need to know the formula how to calculate. I'll show you the formula. And state of mind means how you control your emotion. When the market is going up, you should not sell, sell, sell. Right? You should only buy, buy, buy. So this is how you control your emotions. All 3 are important for you to become a good trader. Right? Now, I will cover these 2 in these 2 days. By today, I will cover money management. Tomorrow, we will cover strategies. State of mind can only happen when you start trading. Then I'm able to coach you. How do you control your fear, hope, greed? How do you control all these emotions? So it's very difficult to teach this. This can only happen when you start trading. Okay? So let's talk about money management first. Let me start off by giving you an example. Let's just say if you start trading with 2,000 US dollars. Okay? Now, here's the first question. When you lose your money, when you lose, say, 10%, is 2,000 minus 200, you get 1,008. From 1,008, you want to bring it up back to 2,000, you have to make about 11%. Okay? It's not 10% because 10% of 1,008 is only 180. Right? So you need 11%. Now, what if you lose 50% of your money? 50% means from 2,000, you lose 50%, you're down to 1,000. Does anyone know from 1,000 how much do you need to make to bring it up to your original amount? Correct, it's 100%. It's 100%. Okay? And in the worst case scenario, if you lose 90% of your account, you're left with only $200. Do you know how much you need to make back? You need to make 900%. So the first concept I want to teach you is that it is very easy to lose money, but it is more difficult to make it back. You need more time. You need to have more winning trades to bring it back up. So many people are very interested how to make money. But I need you to understand that not losing money is also important. Because if you trade wrongly, if markets are going up and you sell, 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 and you lose a lot of your account, what will happen is that you need a lot of time for you to build your account back. For those of you who have started trading, you will understand what I'm talking about. You can have a very nice, you make a lot of money, but because of 1 or 2 stupid mistakes, you end up losing more than half of your account. And all the effort that you took to build the account has all been wasted. Okay? So by listening to money management, I hope you guys can understand how to protect your account. Right? Now, let me ask you a very important question first. Why do so many traders blow up their trading account? There's more people who lose money in Forex compared to people who win. At least 80% of the people lose. So 80% of the people lose, 10% may break even, the other 10% will win a lot of money, right? Before you start thinking, oh, does that mean I will always lose? No, switch your mind. Tell yourself you want to be part of the 10% that is making a lot of money. All right? The people who lose, they will always lose. I don't know if you, some of you were in the press conference yesterday, and I mentioned that there's always a 80-20 rule, right? Have you all heard of the Pareto principle? This is called the Pareto principle. Pareto principle is called the 80-20 rule. If you want to be a, let's talk about business. Does anyone know, okay, have you heard of names like Donald Trump, Richard Branson? Have you heard of all these names? Are they billionaires? Yes, right? But does everyone who start a business, will you become a billionaire? No. For every Richard Branson, for every Donald Trump, for every Bill Gates, Warren Buffett, Carlos Slim, for every people in the 20%, there's obviously 80% who didn't make it, correct? Yes or no? You never hear about them because you don't hear about them. They've already failed. So that's 80% in the business world. What about in the entertainment world? You know, will everyone be a Ellen DeGeneres? Will everyone be a Oprah Winfrey? No, it won't be. 80% of people will fail, right? So what I'm trying to tell you is that the percentage in Forex is the same. Same. 80% will lose. But let's not focus on the 80% of people who are losing because they don't know what to do. After these 2 days, you will know what to do. Let's focus on being in the 20%. Is that clear? Yes? So, the question I want to ask you, why do so many traders blow up their trading account? It's a very good question because if you don't know why, you will always end up losing money. Always. So I'm going to answer this question for you today, all right? Let me talk to you about brokers. Brokers are people, when you start trading, you will fund your account into a brokerage firm, okay? So to be successful in trading, you need 2 ingredients. You need to have very good knowledge. You need to have a very good broker. Both are important. If you have a very good broker, but you don't know how to trade, you'll still lose money. If you know how to trade, but the broker is screwing with you, okay, you will also lose money. You need both. Clear? Yes? If you feel like sleeping, do some push-up, okay? So you can wake up. I know it's after lunch, right? The session after lunch is always the most difficult to stay awake. Now, so let me tell you, so let's move on, all right? Why do so many people lose money? Number one, many brokers will tell you you can open an account between $2,000 to $3,000. This is what many brokers will tell you. And then you know now that 1 pip is 10 US dollars, right? Everybody knows this. But what is the reason when you, within a week or 2 weeks of opening your account, you end up having a margin call? You end up losing your entire account, okay? And the people who lose their account, they will end up saying the Forex market is risky, it's nonsense, this is not for me. The main reason why people think Forex is risky is because they don't know how to calculate their lot size, okay? There are basically 3 groups of people. Is my speaking okay, friends? Yeah? So there are three groups of people. I want to show you how people calculate their lot size. Do you guys know what is lot size? That means each time you click buy or sell, do you trade with 1 lot, 2 lots, 5.2 lots, 6.8 lots? How should you calculate it is very important. Okay? Because if you don't calculate it properly, in the previous slide you saw, if you lose more, you have to spend a lot of time to build your account back. So there are three groups of people. Now let me show you who are these three groups of people, okay? The worst group is people who don't calculate their lot size. Don't calculate meaning to say for each trade, they just sometimes they put 2 lots, 5 lots, 10 lots. They don't calculate at all. The second group is people who do calculate the lot size, but they calculate it wrongly. The first group is obviously the people who calculate the lot size correctly. Okay, now, let's not even consider this group, because this is the worst group. Today, I want to show you how 80% of the people are calculating their lot size wrongly. Okay, so after you understand the mistakes that they are doing, then you know how to avoid this mistake, and then you will know how to calculate it correctly. So let me talk about how people calculate their lot size wrongly. Right? How do most of them trade? Let me give you an example. Let's just say you open up your trading account. Right? Let me give you an example. So you may open it up with $3,000 US as an example. You choose leverage of 100:1, which is a very common leverage that you will choose anyway. And this is the mistake. The mistake is that people, how they will calculate lot size wrongly is that they will take the money that they have, 3,000, multiply by 100, which is the leverage that they have, divide by 100,000. Why divide by 100,000? Because in the Forex market, 1 lot is $100,000. So this formula, no one teaches them, but it is something they think, I think this is the correct formula. So many people think this is the correct formula. And now they will arrive, if I have $3,000, I am able to trade 3 standard lots. Follow me with this example. Let's see what happens. So, as an example, you started trading with $3,000. Okay? Maybe you are going to go long. Your entry price, your profit target, your stop loss. Let's assume that you want to make 30 pips profit target and 30 pips stop loss. Okay? If you make money, how much money do you make? If you hit your profit target, how much money? You played with 3 lots, multiplied by 30 pips, multiplied by 1 pip, $10, right? How much is that? So if you hit your profit target, you made $900 US. Is that a good trade? Very good. Very good. And in terms of percentage, you made $900 divided by your account, which is 3,000. 900 divided by 3,000 is how many percent? Anybody? You made 30% in one trade. Is it good? Fantastic. Very good. Now let's consider the other side. What if you didn't win this trade? I don't win every trade. You won't win every trade, right? So let's just say the trade didn't touch your profit target. It went down to touch your stop loss. And you would lose 30 pips. So in the same example, how many percent would you have lost? Is this good or no good? Bro, help me rub. I want to show them something. The principle I want to share with you is that when you risk too much, when you calculate your lot size wrongly, in this case, his calculation is 3 lots. That is a wrong move. When he said that I can play 3 lots, if you make money, you feel very happy, right? You will feel the Forex market is fantastic, right? The banks are giving me 5% per year, 6% per year, but one trade I made 30%. The Forex market is fantastic. But the same person who lost the trade would say the Forex market is risky. I don't like it because I lost 30%. I told you earlier today, it's not that the Forex market is risky, it's that you are risky, right? So you need to learn how to calculate the correct lot size. Before I move on the slides, so just now, in summary, we said USD 3K. We take 30 pips. This guy thinks he can trade 3 lots. If you win $900, which is 30%. If you lose 900, which is minus 30%. Correct? Let me ask you a question. What if you lose 4 times in a row? What will happen? What if you lose 30, 30, 30, 30? Are you still alive? You would have finished your account. Finish. Now here's the important part. Is it normal for traders to lose 4 trades in a row? Yes, of course. I have lost 8 trades in a row before. But because I didn't risk 30%, I'm still alive. Those of you who calculate your lot size wrongly, by your 4th trade, you are out of the game. You are finished. A key statement in Forex trading is that you must last the game. You must have enough money to last the game. Who knows what can happen? Who knows? No one knows. Now let me show you an example, okay? I told you before that losing 4 trades in a row is normal. It is normal. But if you were to trade like that, let me show you a scenario. Out of 10 trades, right? This is 10 trades. Here is an example of you win 6, you lose 4. So this is a 60% probability, right, of your trades, correct? But if you had risked 30% per trade, are you still in the game after 4 trades? No, you're not. So you won't even have a chance to last 10 trades. Now, if you think further with me, every strategy has a winning probability. 60% is a good winning probability. 60% means out of 10 trades, you will win 6, you will lose 4. This is good enough. Okay? After you hit 4 losses, if your strategy has a 60% winning chance, you are not supposed to stop trading after 4 trades. The problem with most people is that after you hit a few losses, you get scared, you don't dare to trade anymore. I'm here to tell you, after you hit 4 losses, you cannot afford to stop trading, because the probability will even out at the end. It's such an important statement. Do you understand what I mentioned? Shall I repeat that? Friends? Understand? Let me say it again. Having a 60% winning probability is fine. That means out of 10 trades, you win 6, lose 4. It is okay. No problem. In trading, as long as you win more than you lose, you are fine. Okay? The problem here is that when you risk 30%, after 4 trades, you are done. You are finished. You are not even in the game. But I'm here to tell you that after you lose 4, you must continue trading. Because after you have lost the first 4, it actually means the next few will be wins. because the probability never changes. So you cannot afford to stop trading after you lose 3 or 4. You must continue. The problem is, how do you continue when you risk so much? So of course the answer is, you should not risk 3 lots. Now let me show you how you calculate properly, okay? Okay, I jumped ahead just now, so let's refresh here. So if you win 900, right? We mentioned. This is a summary. Because you took 3 lots, times 30 pips, times 1 pip, $10, divide by your capital of 3,000, you made 30%. And you feel it's fantastic. But if you lost that trade, you would also lose 30%. And the problem with losing 30% is that if you lose 4 trades in a row, you are out of the market. You have finished your account. You don't have a chance to stay in the market. So this is the number 1 mistake of most traders. Number 1 is that you risk too much of your capital per trade. After 30%, if you were to lose 4 in a row, you're out, right? Because you would have lost more than 100%. This is a good statement I want you to understand. Amateurs are concerned with how much they can make. Professionals are more concerned with how much they will lose. When you protect your downside, your profit will take care of itself. Learn to protect your downside. Always put a stop loss. Always calculate your lot size properly. Understand? Let me ask again, do you understand? Okay. Now, write this down. This is so important. I'm going to talk a little bit more advanced concept, okay? So this is a basic concept. You never risk more than 3% of your capital per trade. What do I mean by that? Let me write down for you so that you understand. In our previous example, if you lose $900, it means you lost 30%, right? In the same capital, 3,000, not risking more than 3% means even if I were to hit a stop loss, the maximum amount I will lose is $90. Because $90 divided by 3,000 is 3%. So even if I lose 1 trade, right, $90, the next trade I have $2,910 to start trading. This is very safe. Even if you were to lose 4 in a row, you only lost 12%. Even if you lose 12%, it doesn't matter. With the probability, you are able to make it up a lot faster. But the most important point, you are still in the game. Right? So the golden rule is that you never risk more than 3%. How do you calculate? Write down this formula. This is your formula for calculating your lot size. Okay, we will go a bit slow, but it is important. Your risk equals to your lot size times your number of pips times your pip value divided by your capital. So your main job is to calculate lot size. Lot size equals risk times capital divided by number of pips times pip value. Now let's do it slowly. Lot size equals risk times capital divided by number of pips times pip value. So this is X. You are supposed to calculate your lot size. Risk. I told you that traders don't risk more than 3%. I will allow you to risk either 1% or 2% or 3%, but nothing more than 3%. So let's just say you want to take the maximum risk of 3%. So X equals risk is 0.03. Right? Don't risk more than 3%. 3% means 0.03 times your capital. How much capital do you have in your account? Doesn't matter if it's $1,000, $2,000, $10 million, whatever money you have in your account, write it down. So let's just say your account is $2,468. I don't care. Write down the full answer. Okay? Because this formula never changes. Whatever amount you have in your trading account, write it down. Divide by number of pips times pip value. We all know pip value is 10. 1 pip is $10, right? So what is number of pips? What is this figure? Tomorrow when I teach you some strategies, number of pips means from your entry price to your stop loss. It is this figure here. Number of pips means the distance from your entry price to your stop loss. This is different every time. This depends on the strategy that you use. Tomorrow when I teach you the strategy, it becomes more clear. All right? So I will teach you how to measure from the chart. It is not a fixed number. You have to calculate it every time. So when you calculate, the answer may be 38, it may be 64, maybe 73. Whatever the number you calculate. Why will the number be different? Because you will be trading different currency pair. Some of you may like to trade dollar-yen. Some of you may like to trade euro-dollar. Some may like to trade the Aussie dollar, Canadian dollar, right? Different charts will move differently. I will teach you how to calculate tomorrow. Right now, just understand the formula first. So let's just say your answer when you calculate is 64. Now you can find out what is your lot size. This times this. This is how much money you have in your capital. This one you measure from the chart. This one you know it's 10. This one is how much you risk. And then you will have your answer. Are you clear? Is this easy or difficult? Difficult. Okay. Do you need me to repeat? Yes. Okay. Which part? Ask me a question. Which part do you want me to repeat? I'm sorry? Number of pips, okay. So, let me show you an example. Let me show you an example. How do we calculate number of pips? Now, let's assume tomorrow I'm going to show you a chart. Right? I may tell you to buy here. Maybe the chart is euro-dollar. Okay? And then when I ask you to buy here, the price may be 1.3750. Example. If you buy here, I will tell you based on my strategy, the stop loss you put below the last low.